Okay, now we're going to talk about what's called the tax benefit rule, or the tax benefit rule doctrine. The basic tenet is this: tax deductions and credits are generally taken in the year when the economic expenditure is made. Tax deductions and credits are generally taken in the year when the economic expenditure is made. Now, if a previous deduction is recovered in a later year, that also means that when you got the recovery of it, it's going to be taxable to you because you got a tax benefit in a prior year. Now, if you paid for something or expended money in a prior year, but it did not generate a tax benefit, then when you get it back, it's not taxable. So now you might say you paid something in a prior year, and you did pay it, but it didn't lower your tax. How could that be? Well, for example, let's say that you paid something in a prior year. You put it on your tax return. But lo and behold, it's the year in which you became subject to the alternative minimum tax. Now, the alternative minimum tax is a completely separate federal income tax system. And every year you're supposed to compute your tax under the regular system and the alternative minimum system. And you have to pay the higher of the two. So if you paid for something and you deducted it on, let's say, an itemized expense deduction, and it resulted in your regular tax being lower than the alternative minimum tax, you have to pay the alternative minimum tax. So you paid it, but you derived no tax benefit from it. Okay? So the point here is, under the tax benefit rule, you made an expenditure, okay? There is a deduction, and if you later get it back, it will be income to you, assuming you got a benefit in the prior year. Now, that may sound rather esoteric, and it may sound like something that's going to be very complicated, but it's something that I think almost every taxpayer I can think of has experienced. Let's say that you got a federal and state income tax refunds this year. Now, if you were able to deduct the state and local income taxes in the prior year, so you itemized your expenses, you got a deduction, now you're getting a refund from that prior year. So you had a tax benefit when you wrote it off. Now it's coming back to you. You're going to pay tax on it. If you did not itemize your expenses, you took a standard deduction, you didn't get a tax benefit, you get it back on a refund a later year, it's not a taxable item. A lot of sole proprietorship businesses and other types of businesses, corporations, whatever, they allowed, of course, to write off bad debts. People or businesses owed them money, they didn't pay, they write it off. Well, if you write it off and you're convinced that you're not going to get it back, but let's say a later year you press harder on collections and you get it back, okay, you had a tax deduction in the prior year. So now you're finally getting paid, so you're going to have to take it into income. Real estate taxes. Let's say you pay real estate taxes on your home, you take a deduction for it, and let's say that you think that your home or the building is overvalued for real estate tax purposes. So you appeal the ruling. Now in Pennsylvania, that usually is something that's determined at a county level. You can go and fight it. So, I remember maybe 10 years ago where I live, the county decided to reassess everybody's properties. And and they did, and I just felt that the assessment, everybody where I live, we all live it's a condo complex, we all thought the new assessments were too high. And there was such outrage that the county set up ways, and you go to these appointments and meetings and appeal. And so many people were upset. They had a lot of these. And what I noticed almost right away was that everybody who went to these informal meetings were losing. The appeal was denied. So my neighbors just gave up. Now, you could go one step further and petition for a formal appeal. So I did that, and I won. The person who did the appraisal of our properties had made a mistake, and he was there, and he admitted, because I had evidence about the value, and he admitted that that was wrong. So they adjusted my real estate tax and lowered it. But the way things work, my neighbors, they would not, the county would not automatically go back and adjust it. They had to go and do the appeal. And some of them didn't want to, most of them didn't want to pay an attorney or an accountant to handle it, so they just ate it. So that's the way it goes. So the point being that if you derived a tax benefit in a prior year from an expenditure, and in a later year you recoup that, it's going to be taxable income when you recoup it. Thank you.